Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 high-yield dividend stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at a few companies in the energy sector that all have a high dividend yield and also come in with a strong buy consensus from Wall Street analysts. Now, of course, high yields can be very attractive, but make sure that that's not the only reason that you're taking a look at a stock. A stable dividend, normally around that 2 to 5% yield, but I know that some of you guys are searching for higher than that, so I want to share these today. Just keep in mind that sometimes yields can look inflated if a stock price has recently taken a drastic drop, or maybe the dividend just isn't as stable. But today I try to find you some stocks that is not the case, that do have a decent track record, but just always keep in mind the risks involved. Make sure you do your own research and due diligence, and you're sticking to your investment plan. Now, we've found today's high-yield dividend stocks using the TipRanks stock screener. That can be found under stock ideas right here, and I put in a few metrics including a very high dividend yield, a strong buy analyst consensus, and trading on major markets. Down here, we got our list with the results. First up, we're taking a look at Western Midstream Partners. Their stock trades under the ticker WES, currently priced just shy of $26 per share with a market cap of about $10 billion. The stock is up 4% over the past year and a couple percent over the last few months. As the name suggests, they are an energy company focused on the midstream sector in the American West, particularly with operations in Texas and the Rocky Mountain region. They are in the business of gathering, compressing, treating, processing, and transporting natural gas liquids, and crude oil, and gathering and disposing of produced water. Their network includes 23 gathering systems fed by nearly 15,000 miles of pipelines, supplying 71 processing and treatment facilities. 50.6% of Western Midstream Partners is owned by Occidental Petroleum as well. They have been paying out a quarterly dividend since 2013. The current dividend comes in at 86 cents per share for a dividend yield of 7.71%, which is well above the sector average. When we look down below here, they have been fairly consistent, but they did have to cut their dividend back in 2020, along with many other companies. That has been on the rise ever since, though. The current 86 cents dividend includes their quarterly base distribution of 50 cents per unit, plus their enhanced distribution of nearly 36 cents as well. At the start of May, the company did post an earnings miss, with earnings per share of 52 cents, falling short of the 64 cents anticipated. Earlier this week, though, the company did release the sanctioning of a new cryogenic plant, plus reaffirmed their full-year guidance. They sanctioned a new 250 million cubic feet per day cryogenic processing plant in West Texas. It is expected to be in service near the end of the fourth quarter in 2024. The company also confirmed their base distribution of at least $2 per unit. Western Midstream Partners does currently come in as a strong buy with 9 current analyst ratings. With an average price target of $32, that would be an upside potential of 23% for the next 12 months. Looking at the most recent ratings here, we have a buy from just a few days ago with an upside of nearly 23%, and the rest all coming in that nice double-digit upside potential. For our second high-yield dividend stock, we're looking at Sitio Royalties. Their stock trades under the ticker STR, currently priced at about $25 per share. Now, they are down over 4.5% the past year, but have seen growth of 12% over the last few months. Now, they operate a bit differently than a typical energy company, as they own and manage oil and gas, mineral, and royalty interests. They are a pure-play mineral and royalty company that acquires high-growth oil-weighted rights in productive and high-quality U.S. basins. With over 185 acquisitions to date and over 260,000 net royalty acres, they are the largest unconventional resource play in the United States. Their strategy is to continue executing on large-scale acquisitions through a disciplined and opportunistic approach that creates long-term value for its shareholders. They target paying a dividend of at least 65% of discretionary cash flow and using retained cash flow to protect the balance sheet, maintain liquidity, and fund cash acquisitions. Sitio pays a quarterly dividend that is currently 50 cents per share. That works out to a current dividend yield of over 10.5%, which is well above the sector average. It is worth noting, though, that while they have been paying a dividend for several years, it has fluctuated over those years, so this is not quite as stable of one. The company did report their most recent earnings on May 9th. And while their earnings per share of 28 cents did come in 4 cents ahead of expectations, revenue of $150 million missed by just over $5 million, though it did grow over 100% year over year. The company also reduced their long-term debt by over $33 million. Satio only has 4 current analyst ratings, but they do come in with unanimous buys. The average price target comes in at $31 per share for an upside potential of 22%. The most recent rating just from a few days ago with an upside of 26%, and the others ranging between 11 to 35% upside. And our third high-yield dividend stock, we have another midstream company with HESM Midstream. With a market cap of over $6 billion, they trade under the ticker HESM, currently priced just shy of $27 per share. Now, they are down 11.5% this past year, but down just a couple percent the last few months. HES Midstream came into its own back in 2017 when they spun off from HES Oil, taking their parent company's pipeline operations. They now own and operate a profitable network of transport assets for hydrocarbon industry liquids in the Williston Basin on the Montana-Dakota border. Specifically, the company's network moves oil, gas, and produced water in the Bakken and Three Forks shale plays. HES Midstream also pays their dividend out on a quarterly basis. And with the current dividend amount of 58 cents per share, that gives them a dividend yield of about 8%. Now, these guys have been paying a dividend since their spinoff in 2017 and have been increasing it steadily ever since. They reported their most recent earnings near the end of April, where they did come out with an earnings miss and not their first, but the company did reaffirm their full year guidance. Earnings per share of 47 cents was 4 cents shy of analyst expectations, and revenue of $305 million did come in just about $7.5 million short. But despite this, following the report, we have had several analysts coming in with buy ratings. The stock is currently rated a strong buy based on 5 buys and 1 hold, with an average price target just shy of $35 per share, which would be an upside of over 29%. And we can see a lot of analysts agreeing right around that $35 price point. Everyone is pretty closely knit here. So there we have 3 energy stocks, all with buy ratings from analysts and some pretty attractive dividend yields. As I said before, though, those high dividend yields can come with some more risk, so just make sure that you always understand your investment objectives, your own risk tolerance, and are doing your own research and due diligence. If you made it to the end of today's video, make sure you hit that thumbs up button and let me know some of your other favorite high dividend stocks in the comments down below. I always appreciate hearing from you guys. Thanks so much for watching. Have a great day, and I'll see you back here next time.